Okay, let's get right into it. We're going to break down the exact investing strategies that took Mark Tilbury from being a beginner with almost no money to a multimillionaire by the time he was 35. This really is your roadmap. So let's start with the big question. Do you want to be rich? I mean, it's a goal for a lot of people, right? And that's exactly why you see so many get-rich-quick schemes out there. So many people have this, a lottery mentality, just hoping for some magic bullet. But that is not how real wealth is built. Because here's the thing. The real goal isn't just about piling up a bunch of money. It's about freedom. For Mark, he always dreamed of being a race car driver. And as he built up his investments, that dream, well, it actually became his reality. It gave him the freedom to compete, to win trophies, and even the freedom to make videos like this to explain his journey. Now that's the real prize. So how do you get there? Well, the key is having a solid, consistent plan. It's so incredibly easy to get distracted by the next shiny thing. Bitcoin, penny stocks, the list goes on. But the secret, really, is to tune out all that noise and only invest in things that you actually truly understand.
And this is so crucial. Step one in our whole roadmap is to build a rock-solid financial foundation. Before you even think about investing a single dollar, there are 3 things you've absolutely got to get in order first.
Okay, let's break down this foundation. First up, focus on increasing your income. Seriously, forget about pinching every single penny and making your life miserable. Put that energy into earning more. Second, you gotta crush that high-interest debt. I'm talking credit card bills. That stuff is like an anchor just weighing you down. Get rid of it. And third, create what's called a freedom fund. Basically, it's an emergency fund with 3 to 5 months of your living expenses. This is what protects you when life throws a curveball. All right, with our foundation totally set, we can move on to step 2, choosing your investment vehicles. Now we're getting to the fun part. We're going to look at a few different options, but we'll start with the lowest risk and honestly a fantastic place for any beginner, index funds. Okay, so what is this slide really showing us? Well, think about it like this. If you put all your money into one single stock, let's say Apple, and something goes wrong with Apple, you could lose everything. It's risky. But with an S&P 500 index fund, you're not just buying one company. You're buying a tiny piece of the 500 biggest companies in the US. Apple, Microsoft, Amazon, they're all in there. So if one company has a rough year, it's balanced out by the other 499. That right there is the incredible power of diversification. Now, a question I hear all the time is, okay, but why not a mutual fund? They sound kind of the same, right? Well, a mutual fund is actively managed. You've got a professional, a fund manager, whose entire job is to try and beat the market by picking what they think are the best stocks. And that sounds great in theory, but there's a pretty big catch. And boom, this slide just makes it so clear. It all comes down to the fees. A passively managed index fund might charge a tiny 0.07% fee. So on a $10,000 investment, that's just $7 a year. But a typical actively managed mutual fund, they can charge 1, even 2%. That's up to $200 a year, going straight into the fund manager's pocket, even if they lose you money. And over a lifetime of investing, that difference is absolutely massive. Now, index funds are a fantastic, pretty hands-off way to invest. But there's another powerful vehicle, especially if you're the kind of person who likes tangible assets you can actually see and touch, and that's real estate. Mark is a huge fan of this. His very first property was a 1-bedroom apartment he bought for about $50,000. He rented it out for $500 a month, and then 10 years later, he sold it for $150,000. That experience right there is what got him totally hooked on the potential of property. So how do you even spot a good real estate deal? Well, he uses this super simple rule of thumb called the 1% rule. Just like he says, if I buy a property for $100,000, then a minimum I want it to bring me in $1,000 a month. It's just a really quick calculation you can do to see if a property has good cash flow potential right off the bat. All right, the third vehicle we're going to look at, and listen, this one is for those with a bit of a higher risk tolerance, is individual stocks. This is where you can see those really big swings, but the absolute golden rule remains. You must understand what you are investing in before you put any of your hard-earned money into it. So there are 2 main ways to evaluate a stock. The first is quantitative analysis. Think of this as being the detective. It's all about the numbers. You're digging into the company's balance sheets, their income statements, their cash flow reports, all the hard data to figure out its actual financial health. The second method is qualitative analysis. So if quantitative is the numbers, qualitative, well, that's the story. It's about all the abstract qualities that can make a company great. Think about Tesla for a second. It's not just about the car sales, right? It's about the visionary leadership of Elon Musk, the incredibly loyal brand community, and its potential to completely shape the future. These are the intangibles that can really drive a company's success. So, we've covered the foundation, and we've talked about the different investment vehicles. But you know what? None of it works without this final, critical piece of the roadmap: the right mindset. This is the master key that really ties everything together and leads to long-term success. So, what are the core principles here? Well, first, be consistent. Pick a strategy and stick with it. Second, and we've said it before, only invest in what you completely understand. Third, avoid chasing the latest trends just because everyone's talking about it. And finally, use your own unique skills and contacts to create opportunities that maybe other people can't see. So there you have it. We've laid out the investor's roadmap, step by step. The path is crystal clear, from building that solid foundation all the way to choosing your investments. So the only question left is, what's your first step?